SoFi's stock price is up nearly 75% this year, making its investors over $3 billion in profits. But if I'm right about this stock, it could have room to 3 or even 5x in price from where it is today. So let's dive in. SoFi is fundamentally a bank. It's a fintech company, meaning it also has really good tech behind it, but it's still subject to the whims of the financial markets. But while other banks have been struggling throughout the year, with March 2023 kicking off one of the largest bank failures of all time, as Silicon Valley Bank experienced a bank run like it was the 1930s. And that wasn't even the worst of it, with a new bank failing almost every other month in 2023. So how was it that SoFi not only managed to survive, but even outperform the big banks like JP Morgan and Wells Fargo? Well, it all comes down to how SoFi's business works, behind the scenes, and a sort of not so secret plan that they are now using, which, if successful, could reshape the future of fintech companies forever. But first, let me set up some context. So SoFi originally started out as a student loan company offering graduate loans at Stanford back in 2011, but they've expanded far beyond their humble beginnings to become one of the leading fintech companies in the US. They did this using a unique operating model where they work like 3 businesses in one, and this is key to their new plan. SoFi's first segment is their lending business, which has now expanded far beyond student loans to also offer personal loans and even home mortgages. And side note, the company pivoted to these new loan types in the midst of the COVID student loan pause, and they did it so quickly and so effectively under their CEO Anthony Noto that the company barely blinked when what used to be the biggest part of their business shut down overnight. Crazy impressive. But this lending business now makes up the bulk of SoFi's revenue and profit. It's the company's cash cow. The second piece of the puzzle is what they call financial services. This is basically everything in the SoFi app. SoFi Invest, SoFi Money, which is basically a checking and savings account, to SoFi credit card, things like that. So whenever I say financial services, think SoFi app. It's not exactly one-to-one, and there's a lot more complexity involved in how they make money, but it's close enough for this discussion. This is what I call the growth engine of SoFi, since it's where they acquire most of their rapidly growing member base. And lastly, they have their technology platform, finishing out the trio, a custom-built series of tools and platforms that form the technological backbone for the rest of their business. And not just their business, even large competitors like the Robinhood investing app rely on SoFi's technology platform to run their business. So each of these 3 segments could be its own business. They all make their own money and they have their own customers. But it's how SoFi is using these businesses together that's the key to them one day coming to dominate the finance industry. SoFi has an almost unfair advantage over other fintech competitors of their size. They call it their financial services productivity loop, or FSPL for short. The productivity loop is the idea that every customer SoFi brings in to their SoFi investing app can later become a lending customer, or a customer that signs up for a student loan can then be brought in as a direct deposit customer with SoFi Money. And as innocuous as that cross-selling opportunity sounds, it has huge implications for the company. Now, financial services productivity loop sounds hairier than it is, so I like to compare it with something that most investors are familiar with, the Apple ecosystem. Just like Apple sells someone an iPhone, then locks them into a walled garden of endless new and exciting tech products that all work better together, SoFi's productivity loop does the same thing with their money. Imagine I'm a customer who first signs up for SoFi for a student loan. Then when I graduate college, SoFi offers me a sign-up bonus to open a bank account with them. So I sign up, I set up direct deposit, and pretty soon all my money is flowing through SoFi's bank accounts. They then send me an offer for a SoFi credit card, and if I make my payments on time, they'll offer me a few free stocks to sign up for SoFi Invest. Until pretty soon, my entire financial world is centered around SoFi and their services. And the craziest part, I'm incredibly happy with all of this. It doesn't take 3 to 5 days to transfer money like with a traditional bank. SoFi's technology platform makes it all seamless and instant. If I overspend on a credit card, I don't need to apply for a personal loan and wait a week for approval. SoFi knows what I can pay back better than I do. And this creates sort of a walled garden effect within the SoFi ecosystem, where as long as I'm using their services and products, everything just works. And by the way, if you're not subscribed, consider hitting the button. We are so close to hitting 50,000 subscribers before the end of the year, and most people watching right now aren't yet subscribed. So if you wouldn't mind just taking 1 second to hit that button, we could hit our goal with just this one video. Okay, right. walled garden. Now, as crazy as things just working might sound a little strange to anyone who's interacted with a traditional bank, what's even crazier are the numbers that show just how well this is working for SoFi's business. Let's say an average customer that signs up for SoFi lending is worth $1,000 over their lifetime with SoFi. Well, if a customer signs up for a loan after using the SoFi app, they are on average worth double a direct lending customer. That's an insane stat because it means selling one new product doesn't just add to SoFi's earnings, it multiplies it because customers use more and more of each service when they're happy with the other services. That's why we can see the rate at which SoFi is selling more and more financial services products is increasing every quarter, almost like an exponential. But hold on a minute, the title of this video is about a new tool SoFi is using, and as powerful as the financial services productivity loop is, that Apple-style walled garden has been a core part of SoFi's plan since they first became a public company. So then the new part of the equation comes in the form of a small line in SoFi's most recent earnings report. It's only one paragraph, so you could easily miss it if you weren't paying attention, but it unlocks SoFi's future potential to grow at a rate that they've never seen before. Okay, so we have SoFi operating for years as three businesses in one with their financial services productivity loop. It's like a funnel. You get cheap customers using the SoFi app, then funnel them into more valuable areas of the company like lending. And this has worked for SoFi up until now, but there's been a limitation. Historically, SoFi would lose money advertising products like the SoFi app and giving out big discounts to customers up front with the plan that they would make it up in the long term by upselling those customers onto loans. And that's been a nice way to keep growing steadily, but it's always limited how fast the company could expand, since they basically had to wait for a customer to take out a loan before they had money to advertise to the next customer. But all of that changed in their most recent earnings call when CEO Anthony Noto said this.
I want to highlight two major milestones. First, 67% of our absolute growth in adjusted net revenue dollars was driven by the non-lending businesses, specifically the technology platform and financial services segments. And second, our financial services segment achieved positive contribution profit for the first time.
Did you catch that? First of all, SoFi's financial services and technology platform are now the main drivers of SoFi's growth, even though lending is where they make all their money. That's pretty crazy, but the second comment is even more interesting to me. SoFi's financial services segment achieves positive contribution profit. So what is contribution profit? Well, Noto is a former banker, so he likes to use big words. But contribution profit is simply how much money a given product or service makes for a company. So SoFi saying that financial services has a positive contribution profit is just the same thing as saying this part of SoFi's business is no longer losing money, it's now making a profit, which completely changes the economics of SoFi's business. The productivity loop isn't needed to grow SoFi since they can now use the money they make in financial services to grow financial services. And we're already seeing the effects of this. This is a chart showing the revenue split between SoFi's different business segments in this most recent quarter. Lending is the biggest, but financial services and technology platform are decent sizes too. And here is that same chart from a year ago. Yeah, that tiny red sliver is financial services. And that comparison shows just how explosive this segment's growth has been. If we imagine SoFi's money is like fuel for a rocket, the more they make, the more they can pour into their tanks to go faster and higher. But also, the faster and higher they go, the more money they make, which gets dumped right back in as fuel. And that uncaps SoFi's future growth potential. Sounds great, right? SoFi is now an unstoppable flywheel of growth that will only stop when they have dethroned JP Morgan as the king of the banks. Well, yeah, if they were the only fintech that was trying to do this. But now we get to the interesting part, the part that's ultimately going to decide if SoFi is going to make us a 3 or 5x return on investment, or if they'll just languish for months or even years. So up until now, we've been talking about SoFi as if they were in a bubble where it's just them selling to customers and those customers buying their products. But that's not how business works. The reason every company doesn't become a $1 trillion business is because of one word: competition. So SoFi needs to not only sell something that their customers want, they need to do it better than companies like Robinhood, Webull, LendingTree. There's this really great quote from Dan Kennedy, who's basically the godfather of digital marketing: whoever can spend the most to acquire a customer wins. Basically, there's an unlimited number of customers out there, and every year, those customers get more and more expensive to acquire. Remember when all it took to get unlimited customers was to give them a free stock? That's not really enough anymore. anymore. So whichever company is making the most money per customer can afford to spend hundreds or even thousands of dollars in advertising and giving away free perks just to get those customers onto their platform. And with SoFi now able to make a profit, not just months later when a customer takes out a loan, they can afford to spend more and more money than their competitors on acquiring customers. And that is where true explosive growth comes from, with SoFi selling 50% more financial services products this year than last year. And that trend is only going to continue. But does that automatically mean that we should invest? As much as SoFi has going for it, it's not perfect. The company is not profitable according to GAAP accounting standards, although if you pull out their stock-based compensation that they don't actually pay in cash, they are making money as measured by adjusted EBITDA. And while they are growing their new financial services powerhouse rapidly, lending still makes up most of their revenue, and that revenue is always at risk of changing interest rates from the Fed. And maybe most important of all, no matter how good of a business you have, you're always subject to consumer confidence. SoFi has spent hundreds of millions of dollars to legitimize their image as a real bank, with giant projects like SoFi Stadium. But even if you polish up your image so that it shines like gold, your customers still have the power to take you down when you least expect it. Now, I like SoFi at its current price. Stockopedia reports its raw book value is only a few dollars off its current valuation, meaning if you broke up the company and you sold it off for parts, you could sell the whole thing without losing too much money. And of course, with the financial services productivity loop and SoFi's brand power in place, I think it's worth a lot more together than it would be in pieces. And that's why I own around $15,000 in the stock with a $3,000 profit so far, which I give regular updates on in my fintech circle community. So to summarize, if SoFi can manage the risks of profitability, lending, and brand while piling money into growing and producing more profit, I think the stock price could rise substantially from here. But let me know what you think in the comments, and please subscribe to help us hit our goal of 50,000 subscribers this year. And in exchange, here's an adorable wallaby holding a stuffed teddy bear. And here's another video you might like. Yeah, the wallaby's cute, but this video's good too.